Welcome to vTalkInsight, Allocator's lens daily for December 25th, 2025. Equities sit near record highs, volatility is subdued, and gold and copper are also at extremes, all while inflation and policy uncertainty refuse to disappear. Today we connect those dots across stocks, bonds, credit, currencies, and commodities from a late-cycle allocator's perspective. In equities, markets are ending the year with a clear pro-risk tone, but on increasingly late-cycle footing. The S&P 500 and Nasdaq have posted impressive year-to-date gains, helped by a powerful run in semiconductor names, and the index has already logged dozens of all-time highs this year. Recent sessions have seen steady, if modest, advances alongside an equity volatility index in the low to mid-teens, signaling a combination of optimism and complacency. Under the surface, earnings are doing a lot of the heavy lifting for this bull market. S&P 500 profits are up around 11% this year, with forecasts pointing to more than 14% growth next year and mid-teens growth into 2027, and semiconductors are even stronger, with sector earnings having surged about 45% and projected to grow more than 60% by 2026. That supports the narrative of an AI-driven investment cycle, and it helps explain why pro-cyclical sectors such as banks and transports, as well as areas like industrials, data centers, healthcare, and infrastructure, are taking turns at the front of the tape. Leadership, however, is not a simple mega-cap story anymore. The contribution of the largest technology and platform names to index returns has been drifting down, and there are signs of a broadening advance into Europe, Asia, and emerging markets, where domestic production and reshoring themes are supporting local growth. At the same time, gains are still quite concentrated in a narrow group of large caps, while many blue-chip names, especially in pharmaceuticals and other defensives, trade on depressed multiples with healthy dividends, suggesting a sizable gap between the market's favorites and its laggards. That gap matters because valuations at the index level are already stretched. Forward price to earnings multiples for U.S. equities sit in the mid-20s versus a 10-year average closer to the high teens, and the top 20 companies trade at roughly 40 times trailing earnings, with forward valuations near 30 times, levels that many investors would associate with bubble territory rather than a stable soft landing. The AI theme magnifies this tension. The current investment surge is seen by some as speculative, with concerns that funding deals could unwind if demand disappoints, and a consortium of major tech firms has reportedly pushed around $120 billion of AI infrastructure debt into special-purpose vehicles, effectively moving leverage off their balance sheets and complicating risk assessment. Positioning and technicals add further nuance to the equity picture. Institutional investors are only slightly overweight equities, and many discretionary managers remain neutral, whereas households look fully committed, with equity exposure at multi-year highs and margin loans having grown sharply in recent months. Some technicians flag a loss of medium-term momentum near current levels and see measured upside targets not far above with nearby support, implying a less attractive short-term risk-reward even if the broader bull market extends into 2026. All of this leaves allocators weighing robust earnings and a still resilient U.S. consumer against stretched multiples, very low volatility, and a long list of macro and policy risks, from potential growth disappointment in 2026 to renewed trade frictions and uncertainty over future Federal Reserve leadership. How rates evolve from here is central to that calculus. So let us turn to the bond market. In rates, the macro backdrop remains conflicted, and that is keeping the policy outlook unusually uncertain. Headline U.S. GDP recently printed above 4%, the fastest in about 2 years, and the Federal Reserve projects growth of roughly 2.3% next year, well above most estimates of trend. Yet a closer look suggests some of that strength reflects temporary factors like trade, while underlying year-over-year growth is near 2%, and expected to slow, and labor market data point to a normalizing but still healthy jobs backdrop. Inflation is the key swing factor for the front end. Core personal consumption expenditures inflation is running just under 3%, and a recent consumer price reading was judged artificially low because of data issues, with adjusted estimates closer to 3% versus an effective Federal Reserve CPI target around 2.2%. Upcoming rent adjustments are expected to push inflation higher in the near term, which, alongside official rhetoric about anchoring inflation at 2%, makes aggressive easing unlikely. While markets are pricing roughly 2 cuts next year, several commentators argue that the Fed's own projections and current inflation trends point to only 1 cut in 2026, and some warn that persistent price pressures might even limit that, especially as political debate around Fed independence and a possible change in share intensifies into the election cycle. At the long end, yields are being pulled in opposite directions. The 10-year Treasury remains range-bound, with some strategists expecting easier policy and even tools like an operation twist to keep yields below about 4.25%, possibly under 4%, while others highlight fiscal worries, deglobalization, and the risk of renewed inflation as arguments for higher term premia and a steeper curve. There's also a global overlay. The Bank of Japan may need to raise rates further as its inflation approaches 3% and growth runs above trend. The Reserve Bank of Australia and the Reserve Bank of New Zealand are leaning more hawkish, and the Bank of England looks close to a neutral rate with internal divisions limiting further hikes. Combined with fragile fiscal dynamics in parts of Europe, notably France, this cocktail leaves long-end yields vulnerable to both inflation and political shocks. For allocators, this means bonds are no longer the straightforward diversifier they once were. Many forward return scenarios rely more on carry than on big capital gains from falling yields, and there's a credible risk that strong growth data alongside rate cuts could actually push long-term yields higher, as has happened in past cycles. That would complicate equity valuation support and could pressure rate-sensitive credit, while simultaneously underpinning assets like the dollar and challenging the narrative behind the explosive rally in gold. The interaction between policy, growth, and term premia is therefore a central cross-asset junction, and its impact is felt most immediately in credit markets. Credit markets, for now, still project calm. Robust nominal GDP, recently running near the high single digits, is supporting loan demand and keeping corporate revenues buoyant, which in turn has kept default expectations contained. In Europe, high yield, and especially single B-rated names, are seen as undervalued after a period of risk aversion linked to U.S. private credit defaults. An improving regional outlook, helped by fiscal measures in Germany and elsewhere, is expected to reduce default risks and support further spread tightening. Some investors even prefer French corporate credit, particularly subordinated bank paper, over French government bonds, viewing bank fundamentals as stronger and yields more compelling, especially when political noise creates temporary dislocations. But the technical picture is becoming more complex, particularly at the long end of investment-grade curves. Heavy upcoming issuance of long-duration bonds from large technology and data center firms, much of it in euros, is likely to weigh on existing valuations and could force a repricing along the maturity spectrum, even though underlying credit quality is not the main concern. At the same time, some big technology groups are financing AI infrastructure through special purpose vehicles, moving roughly $120 billion of debt off balance sheet and blurring where the true leverage sits. In parallel, growth in loans to non-depository financial institutions is flagged as a possible future vulnerability, even if banks have managed this segment reasonably well so far. Outside public markets, pockets of stress are appearing. Several private credit and real estate funds are trading at notable discounts to their reported net asset values, suggesting some mismatch between book marks and investor confidence, and reminding allocators that illiquidity can delay, but not eliminate, the recognition of losses. A resurgence of inflation that forced the Fed to tighten again in 2026 is identified as a key risk for bank balance sheets, as it could flatten yield curves and pressure credit performance, just as loan books tied to non-bank financials and commercial property have grown. For now, Credit spreads still signal a benign environment, but the mix of heavy issuance, hidden leverage in AI and private markets, and policy uncertainty argues for close attention to how funding costs evolve. Those same forces also shape currency dynamics. The foreign exchange landscape this year has been dominated by a weaker U.S. dollar narrative, but the story is not one way. The broad dollar index is on track for its softest annual performance since 2017, down roughly 8% as traders anticipate further Federal Reserve easing. Yet several signals from policymakers point to a shallower cutting cycle, with some expecting only a single rate cut in 2026 if inflation remains sticky, a path that would tend to support the dollar rather than undermine it. On top of that, growing political debate over Fed independence and the choice of the next chair adds another layer of uncertainty that could, at times, translate into safe haven demand for U.S. assets and the currency. Regional dynamics add further nuance. In Asia, currencies like the Korean won and the Japanese yen have seen bursts of strength after forceful verbal intervention from authorities concerned about past weakness, and there is a sense that central banks are more comfortable allowing their currencies to appreciate into next year, particularly as markets expect some renminbi appreciation from what many view as undervalued levels. China's recent policy actions, including targeted housing support and tolerance for a firmer currency, signal commitment to its growth objectives and can influence broader emerging market FX flows. By contrast, the euro faces headwinds from mixed growth data and persistent fiscal strains in countries such as France, where high deficits and a shorter debt maturity profile make the sovereign more sensitive to rising rates. At the same time, the structure of FX markets is quietly being reshaped by digital assets. Stablecoin usage in cross-border payments has risen from almost nothing to around 3% in a year, with some expecting a tenfold increase, while major financial institutions are launching tokenized money market funds on public blockchains, and large asset managers increasingly argue that most financial assets will eventually have on-chain representations. Products that allow spending across hundreds of currencies, including cryptocurrencies and tokenized equities, illustrate how digital and traditional FX are converging. For allocators, this does not change currency fundamentals overnight, but it does suggest that liquidity, settlement, and even the definition of what counts as cash in a portfolio could look very different a few years from now, and it is already influencing flows into commodities. Commodities round out the cross-asset picture with some of the strongest moves anywhere in markets. Gold and silver are in the midst of extraordinary rallies, on track for their best annual gains since the late 1970s, with gold up more than 70% year-to-date and having traded above $4,500 an ounce, while silver has risen around 150% alongside strength in platinum. Several forces are at work. Expectations for future U.S. rate cuts, a weaker dollar for much of the year, persistent worries about inflation, and a series of geopolitical flashpoints, from tensions around Venezuela to concerns over Israel and Iran, all of which have boosted demand for perceived safe havens. The message from precious metals is subtly different from that of equities. Stocks are near record highs in a low-volatility environment, yet the scale of the move in gold, silver, and platinum, combined with evidence of strong central bank and investor buying, suggests that many market participants are willing to pay up for protection against inflation, policy error, or geopolitical shocks, even as they remain engaged in risk assets. That mix of risk on behavior in equities and a flight to quality in metals fits a late-cycle regime in which investors are increasingly focused on tail risks and diversification, particularly as traditional duration hedges in government bonds look less reliable. Industrial metals tell their own story about structural demand. Copper prices have broken above $12,000 per ton, driven by a combination of AI infrastructure build-out, clean energy projects, U.S. stockpiling amid tariff uncertainty, and supply disruptions in countries such as Chile and Indonesia. Longer-term themes around the energy transition and domestic resource security are pushing investors to view copper and related metals as strategic assets, and miners with high-quality reserves stand to benefit from that trend. These same forces, however, also feed back into capex cycles, cost structures, and ultimately inflation, linking the metals market closely to the debate over how high rates need to stay. Oil, by contrast, currently looks more like a cap on inflation than a driver of it, at least in the base case. Markets for crude appear oversupplied, with limited upside for key benchmarks unless producer groups agree on meaningful cuts or a major geopolitical event disrupts flows. Many U.S. producers are dissatisfied with prices in the mid to high 50s per barrel, but indicate they can operate at those levels for some time. While potential regime change in Venezuela would require substantial annual investment and a stable security environment before production could ramp materially. At the same time, escalating sanctions on Venezuelan exports and heightened tensions around Iran's missile program underscore the ongoing risk of supply shocks and volatility spikes. For allocators, that means commodities as a whole are sending a mixed signal. Metals point to both strong structural demand and elevated hedging needs, while oil keeps near-term inflation pressures in check, at least until geopolitics say otherwise. Pulling the threads together, global markets are trading a late-cycle soft landing script. Equities are buoyed by powerful earnings and an AI-led capex boom. Rates are grappling with the tension between sticky inflation and market hopes for multiple cuts. Credit spreads remain benign despite growing leverage in less transparent corners. Currencies are adjusting to a softer dollar with policy divergence everywhere. And commodities are split between record metals and still abundant oil. For allocators, the balance of risks is shifting from directional bets to cross-asset relationships. How long end yields respond if the Fed eases into strong data. How equity multiples react if metals keep flagging inflation risk. How private credit behaves if growth slows. And whether a weaker dollar and tokenization really change the flow of savings around the world. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.